Layn Real Estate University. My name is Conrad Layn. I'm going to share what a reverse market crash is. You might have never heard of that before, and if you had, you're going to still want to listen to this video because it's going to get kind of scary. This is not meant to be a doomsday type of video to get likes and shares. It's just meant to share content that I've learned myself. I'm an investor myself, and so for those that are investor oriented into real estate and want to purchase real estate as an investment opportunity, you might want to listen to this. I'm not telling you to buy or not to buy, just sharing one more perspective that you might want to tread the water carefully. So it's a popular concept that real estate agents and brokers and people that are real estate gurus are typically telling people online on TikTok, YouTube, etc., don't invest because the interest rates are too high. Yes, maybe they're not where you like it, but you have to consider this perspective. You might never, maybe you didn't study economics, maybe you don't know how the market works, where when there's more inventory, prices typically go down, and when there's less inventory, prices go up. That's with jewels, that's with food, that's with commodities, doesn't matter if it's stocks. When there's more of something, you price it less because it's easier to get to. And if it's less of the inventory, prices go up because it's harder to get. Just basic economics, right? So the point of this is, in most markets in the United States, specifically also California, but a lot of other states have limited inventory, and that's just how it is. So most people are renters for the most part. But this is the problem. People are complaining, which is understandable, about the 6%, 7% interest rate. But the problem is this: if Jerome Powell, who represents the federal chair, who can actually bring down interest rates, does that, the problem with that is that will allow these hyper rich people, the 1%ers, the wealthy people, to be able to invest in these dirt price interest rates, and it will outcompete and make the middle class smaller and increase the poor class. That's just what it is. Don't mean to sound insensitive, but the cheaper the price is, makes it easier for the ultra wealthy to purchase and harder for you to buy if you're not in that 1% or that wealthy environment. That's just what it is. The more money you have is the further you can go. They can outbuy you. So what some people look at this is, they want the prices to go down in the interest rate, but the problem is that if it's at 6% or 7%, it will actually bring up that price of that house that maybe was $700,000, for example. It'll all of a sudden be 1.1 or $900,000. What you want to do essentially is, you just want to, wherever you feel comfortable, buy when you can buy. Remember, if the interest rate goes down, more people will be the candidates that can actually purchase this property. So that means, yes, the interest rate goes down, but the buyer pool opens up, and now more people can buy, so it will bring the price back up again. And so that price will actually end up being higher. So yes, you have a lower interest rate essentially, but it will actually bring up the price of the commodity or the actual real estate that you're wanting to acquire. It doesn't matter if it's residential, if it's commercial. Lower interest rates will allow richer and wealthier investors to buy and pick it up pennies on the dollar. So some people, and the way I look at this is buy it when you buy it. Get in where you fit in. That's my personal perspective. That's not me giving advice, but I'm just gonna buy when I buy. If you feel comfortable buying when you buy, do what you gotta do. Be responsible. If you don't, just sit on the sidelines. Not to sound offensive, but the reality of it is that you can't control the market. You can't control the percentage rate. And a matter of fact, if you get your wish and bring it from 6% to 5% to 3% to 1%, you're going to see a lot more people and open up the buying pool. And those prices that were maybe a $700,000 house will be a $900,000 house or a $1.1 million house. Doesn't matter if it's residential or commercial. And then you're really not going to be able to afford it. So yeah, you have a lower interest rate, but you can't even afford the loan. That's because the price quadrupled. That's just what it is. Kind of scary, but just want to share that with you. Reverse market crash. Look it up.